Hi, I'm Harper Jones with Life with Leverage. We coach people on how they can become their own banker using specially designed life insurance contracts. You can check us out at lifewithleverage.com. Would love to hear from you. In today's video, we're going to talk about the flexibility of life insurance premiums. Now, an important note is that some insurance carriers are more specific on how you can fund premiums. Some people are a little bit more lenient. Now, there's multiple reasons on why you would choose one company over the other, and there's a different video I did, I think it was a few months ago. You could search requirements for a personal infinite banking system or something along those lines is what it was. But essentially, here is a good vital point you need to think about. So let's say we're going to fund a premium, and that premium is $100,000 a year. Well, would you like the ability to fund the $100,000 at only one day of the year or a short time window, and you have to do an annual amount? And the answer is, yeah, probably not. I mean, sure, if I can, but our cash flow, especially as a business owner, real estate investor, can be all over the place. So at the end of the day, what needs to happen is have flexibility. So let's say of the $100,000, you might have different components of the premium, what's called a base premium and a paid up additions rider. Well, let's just say you could fund the 100 monthly. You could fund it in a hybrid in chunks, or you could fund it throughout the year, or kind of mix and match the two. So let's kind of walk through it. You could fund that premium annually, as in 100, okay? You could take the 100, and how we design it is a 40-60 blend approximately. So we'd have a chunk of 40 and a chunk of 60. You could fund both those annually. You could fund one annually, one monthly, or flip-flop and do a one monthly, one annual, right? Or you could do the whole amount of 100 monthly. Now, the flexibility of how to fund and then switching it back and forth from monthly to annual is very, very important. And also, there's what I said, the paid up additions rider. Let's say of that premium of 100, that rider is $60,000. And if you have that paid up rider, that flexibility of the rider, so the base premium of 40 would be, say, required, right, for the life of the policy. And then the paid up additions rider is going to need some flexibility. Some companies only let you fund the entire amount all at once each year. Some companies won't let you go higher or lower. One of the insurance companies we use lets us fund the whole amount, spread it out through the year, skip a year, or even go higher than the previous year. So that flexibility is very important. And then also just the premium in general, let's talk about that. So we're talking about funding, or we were just chatting about funding life insurance premiums in general. But what are some other options with the policy if, say, you get down the road and want to stop funding? There's something called a RPU, or reduced paid up. And essentially what we can do after about year 10 or so, if we wanted, now I don't recommend this, but it's an option, you can have the death benefit kind of self-collapse a little bit, and in return, you're able to have no more premiums due for the policy, doesn't affect the cash value, and the cash value keeps compounding and growing just with the less death benefit that'll still creep up over the years. Now, another option is you're going to have dividends and growth within the policy. You could use some of the growth in the policy or the dividends, and you could have that pay the premium. You could surrender some of the dividends to pay the premium from the cash value, or you could do a hybrid of the two. So there's a lot of different ways to pay the premium and flexibility. You can even loan from the cash in the policy to pay the premium. So hope this helps. You can reach out to me at harper@lifewithleverage.com or go to the website and book a call with me. Looking forward to hearing from you.